This is the Debunking Economics podcast with Steve Keen and Phil Dobbie.
The Archives.
Episode 71. Is the Bank of England nuts?
Welcome to the Debunking Economics podcast with Professor Steve Keen. I'm Phil Dobbie. And today, well, they've done it. The Bank of England has pushed up interest rates, adding to the burden on mortgage holders and indirectly renters too. So have they gone nuts, putting up interest rates when the economy is so weak? We'll look at that today on the Debunking Economics podcast. Well, a few weeks back, the Financial Conduct Authority published their Financial Lives survey. One of the key findings was that 1 in 6 of us say we would struggle if monthly payments on our mortgage increased by less than £50. Now, that's not a big margin. And half of those renting would struggle if they had to pay up to an extra £100 a month. Half of them. The worst age group is those aged 25 to 34, almost a quarter of which are over-indebted, to use the Financial Conduct Authority's terminology. And they account for more than a third, this age group, of new mortgages, and I suspect also some of the biggest mortgages. So why, with so many people struggling, why would the Bank of England push up interest rates today? Now, admittedly, a 0.25% rise adds only £10 or £20 to the average mortgage, but that's the average. Those struggling the most will be, of course, those with higher mortgages. In fact, the number of people taking out a mortgage worth £500,000 or more in 2016 is well over double the level of just 4 years ago, and more than 10% higher than it was just before the financial crisis hit, when everyone was a bit crazy. And conversely, those taking out a mortgage of less than £120,000 has fallen threefold since 2007. So bigger mortgages all around, and an acknowledgement from the Financial Conduct Authority of mortgage stress. So given all of this, why would the Bank of England push up rates and impose this burden on a country where wages are going backwards? According to figures from the Office of National Statistics, wages in the 3 months to August 2017 were 0.3% lower in real terms than they were the year before, allowing for the rise in consumer prices. In fact, real wages are no higher now than they were in February 2006. So isn't it counterintuitive to push up interest rates and make people have even less money as they have to pay more to cover their mortgage? So given all of this, Steve, why does the Bank of England think this is a good idea?
I think because they've fallen into believing that the economy's recovered from the crisis they didn't see coming. And now what they're trying to do is to say, let's slow down this booming economy because the unemployment rate has got down to being historically low. So if you look at the unemployment rate now, it's down to well below 5%. It's actually running at 4.4% right now. And that seems like an incredibly low unemployment rate. In fact, it's lower than back in 2005, before the sort of early warning bells of the crisis came along. The crisis beginning in 2008, unemployment was, at that stage, was 5%. It exploded up to over 8%, and then it's now down below 5 again. So I think, well, the economy has reached equilibrium. It's gone past equilibrium, and let's push it back to equilibrium again by putting the rate up slightly.
Yeah, because the big fear, isn't it, that if they don't push up interest rates, then inflation all of a sudden is going to burst out from nowhere. Even though everywhere around the world, it seems, we've got low unemployment and still no sign of inflation picking up. Yeah,
and this is because they've got these two basic indicators that they've got. They talk about the inflation rate and the unemployment rate. The unemployment rate, they relate to the level of economic capacity. So they've got an idea of what they see the capacity level of economic growth, the actual level of economic growth, and the unemployment rate as a bit of an indicator whether you're above or below that capacity level, given whether the unemployment rate's above or below what they call the natural rate of interest, of which there's no such bloody thing, but it's something Milton Friedman invented, so they spend their time trying to find this natural rate. So those are what you can call flow variables. They're not stock variables. And the stock variable, as usual, that I have to focus upon, not because I like it, but because the mainstream ignores it, is the level of private debt. And in that case, what they think is returning to equilibrium is anything but. We're going to get just even on that very simple basis of, what was the unemployment rate before the crisis began. And back to that figure again, it was 5% back in 2008. Well, if you go to 2008, I asked what was the debt level in 2008, then your debt level, that's the one they're ignoring. Actually, the debt level then was higher now than it is now. That's fallen as well. But that level is rising once more. Yeah. So what you're getting is a boom in the economy, largely QE playing a major factor in that, in my opinion, because the only source of an increase in the money supply and increase in demand has been the Bank of England's quantitative easing program, tiny bits of it leaking through to the real economy and causing additional demand there, while the government tries to run a surplus and insanely, for the private sector was deleveraging for a long while as well. But the private sector started leveraging up again in about 2015, and since about 2015, credit's gone from zero. It was actually minus 3% of GDP back in 2014. It's gone from that up to, at the moment, running at about close to 10% of GDP.
But won't that slow? I mean, wouldn't arguably putting the interest rates up help to reduce the amount of credit?
Yeah, it will. And this is what happened in Japan. And this is why I've said the world's turned Japanese, because the Japanese made the same mistake with the same sort of short-sighted economics. It looks at the flow variables, unemployment, inflation rate and so on, doesn't look at the stock variable of debt, because according to the theories it doesn't matter. And what happened whenever the Central Bank of Japan would decide that things have improved, so we can either stop our QE program or we can put rates up, the economy would tank, because what was actually going on was people were borrowing money once more. That credit-based demand was adding to an extreme level of private debt, which had been accumulated in the bubble economy period. The increase in the interest rate didn't just change how desirable it was to take an investment position, which is the way that the conventional theory thinks about what interest rate changes do. Put the rate up, it makes reduces the net present value of future investments. Therefore, there'll be less investment demand. What it does is it causes people's incomes to tank, because they're paying the interest not just on the change in credit, they're paying interest on the outstanding level of debt. And since the outstanding level of debt is 3 to 4 times what it was historically, that tiny increase in the interest rate can force people into bankruptcy. It can certainly encourage them to say, I can't service this level of debt. And because that servicing cost is extreme, then those tiny increases in interest rates can be enough to stop people from taking out money. So credit goes from positive to negative, and you go from a boom to a slump very, very rapidly. And Japan's been doing that for 25 years now.
But it would also stop people taking out newer loans. I'm trying to figure out what's good, a low interest rate or a high interest rate. Which one is better for the economy? I mean, I would have thought a higher one is going to be better if it's going to stop people from overstretching themselves.
Well, they've already overstretched. This is the trouble.
Yeah.
We've overstretched in the UK's case by a factor of 3.5. Again, looking at historical levels, with a peak level of being 75% of GDP for a century, and now the level is 160% of GDP. And you simply, in any change you make to the cost of money in terms of the interest rate, dramatically increases the servicing cost of outstanding debt. And the mainstream ignore this because they think, well, that means people who've got the debt are going to have more money which they can spend. They're seeing this loanable funds idea that one individual lending to another, and therefore when the person who decides they can't service the debt anymore pays their debt down, the person who lent the money gets more money and they can spend more, and the two cancel each other out. Therefore, you can ignore the aggregate level of debt, because that's a bullshit model, and the real model is the banks create money by creating debt. And if you pay the debt off, you're actually reducing the amount of money in existence. That causes a slump. And so what we have seen with the Bank of Japan is every time they think that things have got back to normal on their flow variables, just looking at the rate of interest and the rate of interest, the rate of inflation, and the rate of unemployment, whenever they think the economy is recovering a bit, then they put the interest rate up, thinking that's going to sort of a bit like simmering, causing the oven to simmer. You turn it down from boiling, burning the potatoes to cooking them nicely. Instead, you go from having them on the stove to putting them in the freezer. And it's a complete flip over, because that credit-based demand disappears. You go into deleveraging, and the deleveraging means unemployment expands once more, and you go back into a crisis once more. So I hope, unfortunately, that the Bank of England gets that experience, because they might be in a situation to intellectually understand what the hell's happening now if they listen to their research stuff.
But I mean, I guess, it's perhaps less likely to happen here than it is in other places, because the UK interest rate before this was 0.25% compared to Canada, which is 0.75. In the US, it's 1.25. In Australia, it's 1.5. And surely there's a real disadvantage in having interest rates that are lower than anybody else's, because who's going to want to buy your government bonds, for example, or in fact any company bonds for that matter? I mean, there's a disadvantage, isn't there, in being quite so low comparatively?
There's never been, and certainly in Australia's case, I know this is a fact, and in America as well, I presume in the UK as well, there's never been a government bond issue which has been undersubscribed. If it will all buy corporate bonds, might be a different story. But then again, if you're selling to local institutions, then whether your interest rate's higher or lower than the overseas, it doesn't really matter. Yep. The main thing about a higher interest rate, and this was the situation for Australia for some substantial time, is you get an overvalued currency out of it. So I wouldn't worry about the international comparison so much. The good point is that because rates are so low, then increase in interest rates won't have much of an impact for a while. But if you get to the stage where rates hit 2 and 3%, then you're going to have the economy tanking very, very badly. And that's what I expect the Americans are going to find, or they continue putting back to what they see as normal, because this is the real danger. The economists in charge of this believe the normal rate of interest should be 4%. They think the inflation rate should be 2, growth rate 3, interest rate 4.
And we're a long way off all of those, of course.
Yeah, well, they're getting close to the unemployment rate seems to be getting back to the level they think is normal or below normal. They're amazed the inflation is still lower than they thought it would be. The growth rate appears to be back to the 3% level if you're looking at the American data. So they're thinking most stuff is normal. Let's start edging the interest rate up as well towards what we think is normal, which is 4%. Yeah. Now, at a 4% rate of interest, it would cruel the American economy, and it will go into a slump.
But no one's got the full set, have they? So America's got the GDP figures. They haven't got the inflation figures. We've got the inflation figures in the UK, but we haven't got our GDP is running at 1.5% per year currently. But of course, our inflation is largely because of the weakening value of sterling. But isn't lifting interest rates, couldn't that help? Because if we've got a higher interest rate, isn't that a good way of, you get more foreign investment in the country, so it strengthens the pound, so that, if we strengthen the pound, then that's going to solve the problem with more expensive imports. So it could actually reduce the inflation caused by this poor exchange rate and help reduce the food bill for the average Brit.
I'm going to give you the Gough Whitlam Award for intellectual thinking on economics for that one.
Are you being sarcastic now or not?
Of course I am. Because one thing Gough Whitlam thought would cut inflation back was the 25% tariff cut overnight without warning to Australian industry back in 1973-74. And he seriously went to his grave believing they cut back the inflation rate, which actually rose after the experience. And of course, what it did do was decimate the manufacturing sector. And the last thing the UK needs to do is to do more to decimate this industrial sector. So I'm not about to encourage interest rates to encourage capital inflows into the UK. Sorry, no, I won't buy that one.
But we do have, you'd agree that most of the inflation that we're seeing right now is temporary inflation, and that is because the pound is devalued. 75% of the food that we're buying from overseas is being bought from Europe, and the euro's been going strong, and the pound's been getting weaker. Yeah,
but so I don't think the inflation figures are going to necessarily be sustained for the UK. They certainly. The domestic wage rises certainly aren't enough to continue it into the future. But, we do have is the Bank of England gone mad? It's gone back to the textbook. And that's pretty much the definition of going mad.
But they are talking small increments, aren't they? And don't you get the feeling that reserve banks are sort of feeling their way a little bit? Is 0.25% here and there? So Canada put their interest rate up from 0.5 to 0.75. Now they've decided they're going to sit on their hands. They don't want to go anywhere because they think they've gone far enough. So these small moves aren't going to change the world, are they?
Not going to change the world, but again, compared to the scale of debt when interest rates were sort of 1% levels rather than the 0.25% now, you are talking 4 to 8 times the debt to GDP ratio. So it's tiny, but it can have more of an impact because, again, the level of outstanding debt is, in the UK's case, 3.5 times what it was back when they used to make 1% movements in the rate of interest rather than 0.25% movements. So they are going to find what they're fine-tuning what is actually like a crisis mechanism rather than a fine-tuning mechanism. So that's what they'll keep on going for a while, and then it will tank, and they won't know why.
So if everyone else is raising their interest rates and the UK doesn't, so the UK is remarkably it is pretty much there with Japan compared with the rest of the world. If it just kept it low and the US continued to rise, maybe up to 1.5%, maybe up to 2%. What does that mean for the UK? Well,
it's a possibility of a carry trade developing, and that is people using money in the UK to go and buy American bonds and things of that nature. They call it the Mrs. Watanabe trade because of mainly Japanese, actually dentists more than any other social group. But Mrs. Watanabe, the Japanese housewife who takes out a deposit in an Australian buys Australian bonds and gets both a high rate of interest and the capital appreciation out of the rising Australian exchange rate, which is caused by the level of foreign buying of Australian bonds. So the UK could have a phenomenon like that. But I think I don't think anything is going to be permanent enough to lead to that sort of situation again, because all these economies that are trying to raise the rates right now are going to find themselves slowing down much faster than they expected and going into reverse again. So I wouldn't be worried about a Mrs. Watanabe effect for the UK pound. And I think anything which keeps the UK pound below the levels it reached prior to Brexit are a good idea anyway.
So all the banks that are now lifting interest rates, you think they really are going to step back and pretty much return to where they are now, and perhaps a bit lower maybe in the case of the States?
Yeah, I mean, this is really, so remember central banks thought they had it all under control by using what's called the Taylor rule. And this is the rule that the normal inflation rate should be 2%. The normal real interest rate should also be 2%. And what you do with the economy is operating below capacity, then and that's giving you falling inflation below that 2% level. Then you cut interest rates twice as fast as the fall in inflation. If inflation's rising, you increase rates twice as fast as the increase in inflation. That's the basic logic. It was a fine-tuning mechanism, and right up until September and October of 2007, the person who originated the model, who's actually one of the candidates for the Federal Reserve Chief, Taylor, thought it was all a lot of fun. I don't think he realised that the fun all came to an end in 2000 and 2008. So they're seeing themselves as fine-tuning what is actually part of a crisis mechanism. And that's why I think this particular move by the Bank of England, they get away with 1, 2, 3 or 4 rate rises, but then suddenly find bang, demand falls over much, much faster than they thought. They'll never get back to their 4% normal.
Well, we'll watch this space. The good news is, it seems, if the latest rate rise is putting pressure or will put pressure on your cost of living, you're not alone. And by the sounds of things, it's not going to last too long. But how much damage will it do to the UK economy in the meantime? Now, next time on the Debunking Economics podcast, capitalism without the capital. Remember the old days when we saved to get ahead and the driving force was doing well so we could own more of our own stuff? A nice car, a new house. The more we had, the more comfortable we felt. Well, how much of that is now disappearing as we rent rather than buy? We subscribe to things rather than owning things. Our assets are very low, but our expenses are high. How does that change the driving force of the economy? That's next time on the Debunking Economics podcast with Professor Steve Keen. I'm Phil Dobbie. I'll see you then. Thanks for listening.